What's up, traders? So today I'm going to show you how I use options to take my account from 5,000 to multiple six figures. And so I'll not only show you the exact option frameworks that I use, but we'll also look at the exact data that I use to place any trade and also look at a potential trade within the Moomoo platform. Now, if you're new to the channel, my name is Rashad. I am a full-time options trader and I use the money I make from the market in order to pay for my entire lifestyle. Now, do me a huge favor and go ahead and smash that like button and go ahead and subscribe to the channel. I have some amazing videos coming up here shortly. And do remember that this is not financial advice, nor is it a recommendation to buy, sell, or hold any equities or options contracts. Now, before we get into all the details, I of course have to share a word from God that has to do with either money, investing, or business. And this one comes from Proverbs 31:16, and it says, "She considers a field and buys it. Out of her earnings, she plants a vineyard." Now, this verse clearly discusses the benefits of reinvesting your profits, and it kind of illustrates a woman's ability to identify opportunities, make sound financial decisions, and invest in productive ventures that will benefit their families. All right, so no matter where you are in life, just make sure you're continuously reinvesting, whether that's in the stock market or other aspects of your life. Continuously take what you learned and reinvest it back into your life in a place where it can help you grow a harvest elsewhere. But that's the word of the day. I hope that blesses somebody. But talking about reinvesting, I have to talk about some members in the Trader Freedom community who are doing amazingly well. And so here we have John. He says, "This community has been a game changer. I printed over $22,000 in July in weekly, bi-weekly, and monthly income. Unable to do both income trades and 0DTE at the same time due to account size, so I decided to focus on the income first. I also hit a new milestone, paying out almost $1,500 in commissions. Thanks, Rashad and community members, for the outstanding support and collaboration. Let's keep on going." So $22,000 in 1 month is crazy. So John is absolutely doing very, very well. And I'm happy that he is enjoying our weekly, bi-weekly, and monthly income strategies. So we have strategies all the way from 0DTE, which is for day traders, all the way up to monthly income strategies for our people who are a little bit more busy. And John has absolutely been taking advantage of them. And so I just responded to his post, first off, just congratulating him, and then also giving him some tips on how he can reduce that $1,500 in commissions that he paid. But if you guys are looking for a cool community to join, we would absolutely love to have you. Not only will you get to see my exact trades as soon as I enter them, but you'll get my full options framework via the Trader Freedom course. You'll get full access to ask me questions at any given time. And lastly, you'll be within a community of other traders who all have the exact same goal. So if that is something that interests you, come on and join us. The link is below in the description. But with that, let's get down to business. Now, if you're not new to this channel, you know that I absolutely love selling options. And I like selling options because I love the consistent and reliable income week in, week out, month in, month out. I personally like knowing how much I'll make this week. I personally like knowing how much I'll make this month. And typically I can pretty successfully tell you how much I'll make next month and the month after that and the month after that. All right, because the strategies that I use are very consistent. And so when I started trading options, I knew that I wanted to use a strategy that, one, I didn't need to watch the screen all day, that two, I could do while I was working a 9-to-5 job, and three, I could be very consistent and reliable. All right, I didn't want to have a strategy where I could make thousands of dollars this day, but then I lose thousands of dollars the next day. I wanted my strategy to be somewhat predictable on how much I would make. But because my account was small at that time, I needed a strategy that would allow me to do what I needed to do with a much smaller account. And credit spreads fit that bill for me. Now, if you're new to options or new to credit spreads, I'm going to quickly explain how credit spreads work. However, if you're already experienced with credit spreads, make sure you stay to the end of the video because I'm going to show you a better way to go about it. Now, the objective for credit spreads is to generate income from a stock price staying above or below your strike price. All right, in some brokerage accounts, we'll call it vertical spreads. All right, so there's different terminology. Just know that when you are selling a vertical spread, it is a credit spread. Now, there are two different types of credit spreads. There is a bull put spread, and then there is a bear call spread. Now, with a bull put spread, you are just betting that a stock price will stay above a certain point. And then with a bear call spread, you are just betting that a stock price will stay below a certain point. And if that happens, you just make your money and you go about your day. But let's get a little bit more specific into each strategy. So with the bull put spread, we are selling one option and buying another with the same expiration, but a different strike price. And the maximum profit that we can get is the premium that we received. And so let's look at an example. All right, so in this case, we have a stock that is currently $80. So what we did over here is we came over and we sold a $75 put, and then we bought a $70 put, and that creates what's called a credit spread. Now, for placing this trade, we are just hoping that the stock price, which is currently at $80, stays above $75 by our expiration date. And if that happens, then we just make our money and we go about our day. And it looks like for this trade, we made about $200 for placing this trade. All right, and so that is on the profit side. But on the loss side, the maximum that you can lose with any credit spread is the distance between your strikes times 100 minus the premium premium you receive. And so in this trade, we can see that there is a $5 difference between our strikes from $70 to $75. And so if we times that by 100, that gets us to 500. And then minus the premium we received, which was $200, that would get us down to a $300 max loss. All right, and we would get a max loss if the stock price were to drop below both of our strikes by the end of our expiration date. Okay, so if the stock price that is currently $80 drops down to 70 or below by the expiration date, then we would have a max loss in this situation. And we can see here that that would be $300 per contract. Now, that is part of the benefit of selling credit spreads, is because it takes a lot less money to put on that trade than if you were to do something just like selling puts. All right, so in this example, if we were to just sell a put by itself at $75, then theoretically you would need about $7,500 to place that trade. However, when we turn it into a credit spread, we only need $300 in order to place that trade. So that is quite the difference. But that is the bull put spread. So now let's look at the bear call spread. Now, in this scenario, let's say we have a stock that is currently about $65. Well, what we could do is we could come over and we can sell a call at $70, and then we can buy a call at $75. And from there, we are just hoping that the stock price stays below $70 by our expiration date. And if that happens, then we just make the money we received and we go about our day. And so we can see again in this scenario, the maximum that we can receive is $200, and we'll get to keep that as long as the stock price stays below 70. And then our max loss is again $300, and that is if the stock price were to go above both of our strikes by the expiration date. Okay, so bull put spread, we are hoping that the stock price stays above a certain point, and then the bear call spread, we are hoping that a stock price stays below a certain point. So a quick little recap on the benefits of selling credit spreads. One, it is a very low cash requirement. All right, in the previous example, we only needed $300 to place the trade. However, if we were to just sell a put by itself, then we would have needed $7,500. And that creates a much smaller risk profile compared to the other strategies. And then next, time works in your favor. And that's the case for any option selling strategy. Time always works in your favor, whereas with buying option strategies, time works against you. And since we all know that time doesn't stop for anyone, we might as well use it to our advantage. All right. And then lastly, you can create consistent income. We know exactly how much we're going to make because the premium that we receive is the maximum that we can make for any trade. And so we don't have to hope and pray that a stock moves in a specific direction in order to make money. We already know how much we can make, and we'll use the data available to make it the highest probability of profit trade. All right. So what are the risks of selling credit spreads? Well, there's limited risk because you choose your max loss based on the width of your spreads. And so if you want less risk, then you can make a tighter spread. And so in the examples that we used, I used a $5 wide spread. And so remember, your risk is always the distance between your strikes times 100 minus the premium you received. And so if you wanted to make more money, you could do a wider spread. However, you're technically increasing the amount of money at risk. And so if you wanted less risk, you could just make your spreads tighter, like the $5 example that I showed, and that would vastly reduce the amount of money at risk. However, it also reduces the amount of money that you can make from the trade as well. All right. And then the next risk I see with a lot of new traders is over leveraging yourself. So because credit spreads require such a smaller amount of capital, you often see a lot of people over leverage themselves by doing several contracts on it that they shouldn't be doing. But we will discuss that later in the video. So let's move on. Now, as far as managing this position, you only need to check it once or twice per day. And so I would normally check it sometime in the morning, and then I would check it closer to the afternoon. All right, but that's all it takes. It doesn't really need a lot of monitoring. And then once we hit our profit target, we can go ahead and close the trade. All right, it's very rare that you would need to hold a trade all the way up to expiration. Once you hit your profit target, whether it's 60%, 70%, 80%, go ahead and close the trade and go ahead and re-enter into a new one. But we will discuss that later in the video. Now, when it comes to using credit spreads, you typically will want to use a stock that has a little bit of volatility to it. All right, because you are both selling a leg and buying a leg, you'll need a stock that has some volatility to it, because the more volatility that there is, the higher that the premiums will be. And a stock that I absolutely loved trading, especially during my beginning years, was Tesla, ticker symbol TSLA. And the reason I love trading it is because the premiums were always really high because Elon, well, he likes to talk. And because of that, the stock is just naturally a little bit more volatile than most other large cap companies. And so let's go ahead into the Moomoo platform and look at the data that I like to look at prior to placing any trade. And real quick, I have to give a shout out to the sponsors of this video, Mumu. Beyond just being an amazing platform, they have one of the best promotions I've ever seen going on right now. So if you open up an account right now and put money into it, you can get up to $1,000 in Nvidia stock absolutely free just for opening up an account and placing money into it. And so this is definitely something to take advantage of. On top of that, they're offering 8.1% APY on your idle funds that are just sitting. So it makes all the sense literally just to open an account, place some money in it just for these perks alone. But on top of all of that, their mobile platform is next level. Taking a look at their mobile app, so you can see here, you can see a lot of general information such as earnings and earnings calendars and earnings beats and economic calendars. However, what I like most is this investment theme. So if we click on investment themes, here they categorize stocks based on what they're impacted by. And so what I like most is this one that's called Nancy Pelosi Portfolio. Now, if you're not familiar, Nancy Pelosi is a US Congresswoman, and she seems to always select the right stocks right at the right time. And so Mumu conveniently put all the stocks that she is currently investing in right here on this list for you to see. And so if you just wanted to follow what Nancy Pelosi is doing, you could follow this investment theme in Mumu. But go ahead, check it out. The link is below in the description. You can get up to 60 free stocks, and you can only get that with this link. So go ahead and click it, and you can thank me later. All right, so here we are in the Mumu platform, and now we are looking at the chart for Tesla. And so first thing I want you to know are the Bollinger Bands. And so the Bollinger Bands are these white lines here, but the Bollinger Bands just aim to show you the range that a stock is expected to trade within. And so we can see up here currently that the lower level for the Bollinger Band is 294, and the upper level for the Bollinger Band is 337. And so if I were doing a bull put spread, I would want to be somewhere under that lower level. And if I was doing a bear call spread, I would want to be somewhere above that upper level. All right, because as you can see, most of the time the stock price will stay within the Bollinger Band area. And so that is how it is 95% of the time. And the times that it does not stay within the Bollinger Band, you can see that typically within a few days, first it'll pop out and then it pops back in. And then it stays in for a while, and then it may pop out for a little bit, but it normally comes back in. And that same pattern happens over and over and over again. All right, but the middle line is the 20-day moving average, and then the top line is 2 standard deviations above that, and the bottom line is 2 standard deviations below that. All right, so most of the time a stock will stay within the Bollinger Band area. All right, but the information that I want to take from here is that the lower Bollinger Band is 294 and the upper is 337. And now that we have that information, let's go ahead and look at the options chain. All right, so the next thing we need to do is select our expiration date. Now, for me personally, when I was growing my account, I like to focus on weekly income. So I would normally use expiration dates anywhere between 4 to 11 days out. So if we were to come over here, I would come down to this date that is exactly 11 days out. And so let's go ahead and select that. And the first thing I would do is I would look at the put side. All right, so most of the time stocks go in an upward direction, especially when you are trading a good company. And so I would normally always do a put credit spread, and then I would do a bear call credit spread sometimes. Now, when you combine them and do them at the exact same time, it's what's called an iron condor. And from there, you're just hoping that the stock price stays in between those two call credit spreads that you set. Now, an iron condor is great because it can almost double the amount of money that you can make from a single trade. However, the drawback is you double your stress because any big movement in either direction could create a bad situation for you. But let's go ahead and look at some more data. So the next piece of data that I want to look at is the expected move. And so if you are in the Moomoo platform, then they conveniently put it right over here in this corner. You can see EM plus or minus 19.19, and that is the expected move. And so the expected move is just the largest move that the option market currently has priced in for the specific stock by the specific date. And so they're saying that as of right now, they expect the largest move for Tesla to be about $19.19, either up or down. And so on a downward move, that would put Tesla around 287, 288. And so I would want to be underneath that point. And so typically when using both the Bollinger Bands and the expected move, I would typically go with whichever data point is a little bit more conservative. And so in this case, it would be the expected move. And so let's go ahead and place our bull put credit spread at somewhere under 288. Now, the last piece of data that I like to look at is the delta. Now, the delta by definition is how much the options premium will move per $1 move in the underlying stock's price. However, most successful traders look at the delta as the probability of the event occurring. And so at a 0.20 delta, for example, that is to me saying there's about a 20% chance that Tesla stock price drops down to the strike price by the expiration date. All right. And so in other words, I would have about an 80% probability of profit. And now, while I was growing my account aggressively, I would go up to a delta of 0.30. All right. And so when you're going up in delta, you are taking on more risk in order for higher premiums. But let's say we want to play it conservative. Let's stick to 0.20 or less. And so I could go all the way up to this $287.50 strike or anywhere below it. But let's say for the purposes of this video, we will go right at that $287.50 strike because it fits all three of my criteria. And so what I want to do is I want to sell to open this $287.50 strike. So I will go ahead and click the bid price, and we can see that Mumu automatically loads that ticker for me. And from here, you need to select your long strike, the one that you are going to buy to open. And really, this is up to your personal preference based on typically your account size and your risk tolerance. But let's say that you are aggressively trying to grow, and so maybe you are willing to do a wider spread in order to bring in more income. And so for this, let's go ahead and do a $10 wide spread. And so since we sold to open the 287, I'm going to buy to open the 277. So I'll come over here and I will click the ask price, and that is perfect. Our put credit spread is filled out, and you can see that we would have a max profit of $138 with a max loss of $862. Now, the risk to reward ratio is like that because we are putting on a high probability trade. And just naturally, the higher probability that you have of making money, the larger the risk to reward ratio will be. But the thing is, we are going to set a stop loss so that we never really occur that max loss, hopefully. And when I was using this strategy, I would set my stop loss somewhere around 3 times the premium you received. And so in this case, we received $138 worth of premium. And so I would set my stop loss to 3 times that. All right. And if we come up and look at the P&L curve, we can see Tesla stock prices all the way over here. And as long as the stock price stays above the strike that we set, then we just make the $138 that we received and we go about our day. However, if Tesla stock price were to go down, then we can see our break-even point is about $286. And then if the stock price were to continue to go down, then it would be a losing trade, but then the loss would max out at the $862 mark. However, we have set our stop loss, so we would hopefully get stopped out prior to that if the trade were to go against us. But like I said, this is a high probability trade because we've looked at our data points and put ourselves in the best position possible. Now, when do you take profits? Me personally, I like to take profits anywhere between 50 to 80%. However, if you have a smaller account, you're probably not able to get in and out of trades as often as you like because you don't have as much buying power in order to place other trades. And so when my account was smaller, I would go normally around the 70% mark. All right, once I hit 70% profit, I went ahead and closed the trade and went about my day. But that is just the put side. So let's go ahead and let's turn this into a iron condor by also adding a call credit spread. So what I'm going to do is I'm going to scroll down, and what we want to do is use the exact same expiration that we are using for the put credit spread. And from here, we want to follow the same steps that we use for the other side. So I want to select a strike that is outside of the expected move. And so since the stock price is now about 308, that will put us at about 327 or higher where I would want to place my strikes. And so looking at the $327 strike, that is a delta of 0.24. And so I know I want to go lower than that. And so theoretically, I could come down here to this $332 strike. However, on the call side, because stocks typically go up a lot more than they go down, I like to be a lot more conservative. And so I look at the call side as really just icing on the cake. And so I may go under a delta of 0.15. And so I would come over here to maybe this $337 strike, which is at a delta of 0.149 currently. And then I'll go ahead and hit the bid price. And since we did $10 wide on the put side, you typically want to do the exact same width on the call side as well. And so I want to come over to this 347 and I need to hit the ask price. All right, so now we can see that changes things. So now we are getting a max profit of $224 with a max loss of $776. So now you see how entering into both sides of the trade can really increase the amount of money that you can receive. And so let's go ahead and look at the P&L chart for this as well. All right, so we see how things have changed. Now Tesla stock price is right here, right in the middle. And what we are hoping for is the stock price just to stay within the range that we set here. And as long as it does that, then we just make our money and we go about our day. And so we can see if the stock price were to go down, then our break-even point would be 285. And if the stock price were to go up, then our break-even point would be $3.39. And as long as it stays within that range, then we make money. However, if it were to go outside of that range in either direction, then it would become a losing trade. So you can see as I slowly scroll higher and higher, how the loss gets bigger and bigger, and then it gets maxed out at $776. And then that would be the case on the put side as well at a loss of $776. However, again, we would have set our stop loss, so hopefully we would have been stopped out prior to seeing this type of loss. Now, again, when playing the call side, you really do want to be very conservative with it. Just see it as the icing on the cake and don't be too greedy with it at all. So credit spreads and iron condors were the strategies that I really used very aggressively in order to grow my account. And every time I would get a win, I would do exactly what we talked about at the beginning of this video, and I would reinvest my profits. And on top of reinvesting my profits, I also took any money that I got from my 9-to-5 and I placed it in my account in order to continuously grow it, because the larger your account is and the more buying power that you have, you can place more trades, which can equal more money. But ladies and gentlemen, that is it for this video. I hope you enjoyed it. And again, if you know anybody who's looking for a cool community to join, come join us in the Trader Freedom community. The link is below in the description. But other than that, I will see you guys on the next one. Peace!